If you're waiting for the perfect time to start investing, maybe you're waiting for the bubble, maybe you're waiting for a crash, maybe you're waiting for prices to be better, you're playing the wrong game. Investing needs a long time horizon. So the sooner you start, the better. So before you even start investing, you need to do a couple of things. First one is to clear any high interest debt. Now I'm talking car loans, furniture loans, credit card debts, anything you've got that's a high interest rate. The next thing you need to do is build a buffer. You need to have a buffer before you even think about investing. Because one of the big rules of investing is don't unnecessarily interrupt its compounding. You must give yourself that buffer because if there's one thing that's for sure, there's going to be some kind of financial emergency that you need to fix or that you need to deal with. Step two, you need to think about your time horizon because this very drastically changes your investment strategy. So I would recommend if you've got something you need to save for in the next 5 years, let's say you want to buy a house or you're moving overseas and you need some cash or whatever it is that you have a near-term goal, then you would probably just keep it in cash. Then you're better off in the markets. Now, this is going to be pretty agnostic. Step four, start small, but just be consistent over time. So if you invest $100 a month for 30 years at an 8% return, you're going to end up with $140,000, give or take, having only contributed $36,000. Now that's a pretty good return on your investment, and that's just the power of compound interest. It takes a long time to get that initial push, but once you hit a certain point, it grows exponentially. And given a long enough time frame, your returns start making returns on themselves. The best part about this system is that you don't need to be a genius. You don't need to try and beat the market. You don't need to try and pick stocks, and you don't need to try and be a fortune teller because I'm telling you, that game is not worth it. You don't need to be a hero. Don't need to be a genius. Don't need to try and get absolutely outstanding returns. Just simply buy a good index product and get a decent return and compound over time. Which brings me on to step five, diversification. So what you're not trying to do is you don't want to bet your whole future on one company. You don't want to put all of your life savings in one company because there's so many things that can happen. It is the single point of failure. It is the linchpin to your whole plan. And you are just hoping that they don't have a director go off the rails or some crazy thing happen to their share price or one of their products tanks and kills a bunch of people. It's absolutely not worth it to put too much money into one company. That's where an ETF comes in. An exchange traded fund is where a company packages up a fund, funnily enough, buys hundreds or even thousands of shares across a whole sector or whole market. And that gives you good spread. So if they drop off, if a company drops off, it doesn't really affect your fund because there'll be another one to replace it. Some people say that's a weakness, but it can actually be a strength because whilst maybe the market as a whole isn't doing very well, there's always going to be some companies that are doing really, really well.